And welcome to our class on Introduction to Technical Indicators, sponsored today by Legacy FX. Legacy is one of the world's leading providers of Forex and CFD trading. They are a fully authorized and regulated Forex provider. When you trade with Legacy, you have a choice of 4 different platforms. You can use one of them or all of them or combine them in any which way you feel comfortable with. You can use their simple web trader, which is just a simple log on and you trade right on your laptop, your mobile device, your PC. You can download their app for their mobile trader. You can trade on their MetaTrader 4 platform by downloading the world's leading trading software, or you can use their Xerox Station, which is the most up-to-date trading platform with a wide range of advanced features. Now, you can use one of them or all of them. You decide what works best for your style. And as you can see, their screens are easy on the eye. They're user-friendly, they're dynamic, and they're easy to work with. They're fully customizable. You decide what you want to see on your screen, where you want to see it, and what's important to you. Because the Legacy FX philosophy is simple. Offer focused and personalized services that makes trading logical. They also have a very broad education center, because they want to educate you to improve your trading. They have a multitude of deposit and withdrawal methods. They have their Legacy FX Pro Rewards program. They offer dynamic security so you know your accounts and your funds are always secure. And of course, their trading academy. Now, since Legacy is a regulated provider, I am required to give you a risk warning. I'm going to read the first paragraph, and then I'd appreciate it if you could read the balance that's on your screen. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 76% of retail investors' accounts lose money when spread betting or trading CFDs with Legacy. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Now, today's class is being recorded. And if you wish to see a recorded version of today's class, you can do so by using the same link used to come to today's class. Or if you wait, investing.com will edit this class and clean it up, and you'll be able to find it on the investing.com website, where you register for the class, under the education tab, and then webinars on demand. And in fact, there you can see all the webinars we've ever presented over the last 7 years, and you can sort them and watch them at your convenience, depending on what you would like to see and what you would like to learn. So let's get started with Introduction to Technical Indicators. Now, in today's class, I'm going to use the term security, but I might say the euro. In fact, I'm going to say the euro. I might say Bitcoin. I might say Facebook. I might say Google. But I'm not actually referring to any particular asset. I'll be referring to all publicly traded financial instruments in which an open market exists. But it just gets boring saying security, security, security. Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. We know the difference. But again, there's very few words I can alternate with trading. And just to say online trading, trading on your platform, trading, it's very boring. So we jump back and forth to invest in trading, but you know what we're talking about. Now, today we're going to be talking about one of the sectors of technical analysis. Now, whenever I'm giving a webinar, when I'm giving a live seminar, whether I'm doing a conference, whether I'm doing one-on-one meetings, whether I'm doing some presentation, the first thing people ask me is, what should I buy today? What should I sell? Where do you think the price will be tomorrow, next week, or next year? I can't tell you how many times in the last week I've been asked if gold's going to go to 1,600 or Bitcoin's going to go back over to 11,000. Now, wouldn't investing and trading be easy if we knew the answers to these seemingly simple questions? But I don't have a Ouija board, and I surely don't have a crystal ball. And anybody who tells you they do is full of it. So alas, if you're attending this class in the hopes that technical analysis and technical indicators has the answer to these questions, I'm afraid I must disappoint you earlier. However, if you're attending this webinar with the hopes that technical analysis using technical indicators will improve your investing, that I have good news for you. It surely will. Now, technical analysis is a small field of the overall science of technical analysis. Now, I call technical analysis anything and everything we do on a chart, or we could call it chart analysis. This includes reading a chart. This includes putting support and resistance lines on your chart. It includes chart patterns, like seeing a triangle. It includes reading candlesticks, okay, or candlestick pattern recognition. Then another field we have is called technical indicators. And a lot of traders mix this up. They think the whole science of technical analysis is just technical indicators. But technical indicators are mathematical calculations that can be applied to an asset's past patterns like price, volume, and even other technical indicators. Technical indicators do not analyze any part of the fundamental business like earnings or revenue or profits. Technical indicators are most extensively used by active traders in the market, as they are primarily designed to analyze short-term price movements. To a long-term investor, most technical indicators have very little value. Technical indicators are used to alert, to predict, and confirm. Now, I say technical indicators, or you need to keep in mind, indicators indicate. I firmly believe that technical indicators should be a secondary method. Reading price on a chart should be your primary method. When you can't make heads or tails out of what price is trying to tell you, think of indicators as your interpreter. It tries to interpret what you're seeing in price. Now, charts and prices on charts always have a story to tell. However, from time to time, those charts may be speaking a language you do not understand, and you may need some help from an interpreter. So technical indicators are that interpreter. They look at price information and translate it into simple, easy to read signals that can help you determine when to buy and when to sell an asset. It'll help you determine what the momentum is, the speed of the movement. It'll help you see if the asset is overbought or oversold. Now, there are a lot of different types of indicators, but almost every indicator, in fact, I don't know of any, they rely on 5 pieces of data: the open, the high, the low, and the close, and volume. Because this is the only information you can get from price. And you need price as your basis for your indicator. Now, before I forget to mention this, if you notice on your screen, there's an area that says handouts. I've put in there 2 handouts for you. Okay. You don't have to sign up for these, or you don't have to do anything. Just click the download button. They're PDF files, and then use them at your convenience. One is an explanation of the 5 most well-used technical indicators, what they're all about, how you might want to interpret them, and how to use them. I've also put together for you the Understanding of Technical Indicators guide from investing.com, which is a great resource guide, which will help you with a full range of different types of technical indicators. Now, a technical indicator offers a different perspective from which to analyze the price action. Some, such as moving averages, are derived from simple formulas, and the mechanics are relatively easy to understand. Others, such as stochastics, have complex formulas and require more study. Regardless of the complexity of the formula, technical indicators can provide a unique perspective on strength and direction of the underlying asset. So give me a second. Let me pop up a live chart for you. Okay, here we're looking at the Euro US dollar chart. This is my teaching chart. I use this chart for all my classes. So it's not that I picked the Euro US dollar that I want to influence your trading or give you advice. Nothing to do with it. I use this automatically for every classes. Now, what we see on our chart is the candlestick price chart, which just by looking at, we're employing technical analysis. Now, these lines going across, these green, red, yellow, and blue lines are my support and resistance levels. These are levels I've placed on my calendar using eyeballing support and resistance. This is another technical analysis tool. Now, today our class isn't about support and resistance. It's not even about Japanese candlestick charts. It's about technical indicators. So one of the easiest to use and most popular indicators is called moving average. A moving average is simply a line that's dropped on your chart using an average based on a time period you selected. Now, we have classes in moving averages if you'd like to attend one of our classes. Because again, we're not here to explain to you and spend the time calculating a moving average, but it's one of the most simple, most well-used indicators because technical moving averages takes the noise out of all the markets, takes the noise out of the price movement. It's said that if price is moving above the indicator, it's in a green zone or a buy zone. If price is below the moving average, it's in a sell zone, or you never want to trade opposite of where the price is on the moving average. But this is one of the easiest, simplest of all technical indicators. From there, we go on to something called bands or envelopes. It's one of the few indicators that literally dropped directly on your price chart. This one happens to be called Bollinger Bands. It's a very popular indicator. But as you can see, Bollinger Bands is dropped on your price chart. It is a indicator. Then we can go down and most of our indicators, like MACD, are dropped below the price chart. And then we go down to the full range of indicators that we call oscillators, in fact, bounded oscillators, like stochastics and RSI, which always calculate between 0 and 100. So they're bound in that range. No matter what price does, the calculation will always come between 0 and 100. And then they have a range, whether it's 20, 80, 75, 50, 75, 25, that when the indicator is above or below that range, will tell you the market is overbought or oversold. So these are all the different types of indicators. Now, they're very easy to put on your chart today because our charts are smart charts. All we do is go up to the indicator and locate from the choice. No matter what you're using, they're going to give you some area to put indicators, and locate the indicator in which you want to see and click the button, and it will drop it directly on your charts. It'll also drop it on the charts with the standard periods that are used by whoever developed this indicator. Like stochastics, when it was developed, and its developer, I think it was Gene Wilder. I may not be incorrect, but it was based on a 14 period look back period, a 3-day moving average, and a 3-period moving average of the indicator. Okay. Now you can customize these and change the periods, the colors, everything you want to see. You can change the range. Most indicators allow it. Above there, we have MACD. MACD here is another very popular indicator. Now, as you notice, it's different than stochastics down below because it's not a bounded oscillator. Now, MACD works on what we call a center line, which is a zero line. And we can see in the histogram whether prices are moving up or down, or now that price momentum is moving up or down, and when price is getting overbought and oversold. And when price crosses the zero line, it generates buy and sell signals. But again, we're not here. We have a whole 1-hour class in learning to use MACD. We have a 1-hour class in understanding stochastics, because you're not going to learn an indicator. You're going to learn a field or group of indicators today and what the different types of indicators are. Now, let me go back to our PowerPoint here. Let me just pop this up on our screen. Now, technical indicators are based on mathematical equations that produce a value that is then plotted on your chart. So we have what we call leading indicators and lagging indicators. Now, leading and lagging are not bad or good terms like we have that your son is leading into school or lagging behind in his education. Nope. Leading and lagging are not good and bad in indicators. Leading indicators give trade signals when the trend is about to start, where a lagging indicator are those that follow the price action. So lagging indicators tell us something has started, even though we may not see it, but a trend reversal has started. Where a leading indicator tells you the trend might be ready to end. So they try to predict price by using shorter periods in their calculations, thereby leading the price movement. Then lagging indicators, they give signals after the trend or the reversal has started. So imagine if we're using a simple moving average. To calculate a 20-period moving average, we would take the close of the last 20 periods, add them together, and divide by 20. But since we need this period to close before we can add it together and calculate it, we're using our calculations of previous price. So it's lagging behind because we have to wait for this close. But it's not a bad thing. Okay. Leading indicators precede price movement and try to predict the future. These indicators are most helpful during periods of sideways or non-trending price movement. Lagging indicators follow price movement and act as confirmation tools. So you have to understand which indicators fall into what category when you're going to use them. So let's talk about the different types of technical indicators. These are the different groups of indicators. We're not talking about a specific indicator, because we start out with the first group, which are called trend indicators. Trend indicators measure the direction and the strength of the trend using some form of price averaging to establish a baseline. As price moves above the average, it can be thought of as a bullish trend. When price falls below the average, it can signal a bearish trend. Trend indicators tell you which direction the market is moving in, if there is a trend at all. They're sometimes called oscillators because they tend to move between high and low values like a wave. Trend indicators can reach from a parabolic SAR to MACD, moving average, convergence, and divergence. Okay, that's one grouping of them. Okay. The second grouping, and now the handouts I gave you will show you which indicators fall into each one of these groupings, are momentum indicators. Momentum indicators help to identify the speed of the price movement by comparing prices over time. It can also be used to analyze volume. Okay. Momentum is, if you shoot a rocket into the air, it's going to go up and up and up. At some point, it's going to lose its momentum. It's not going to fall over at that particular point, but we know when it starts losing the momentum, it's about to turn down to earth. We just don't know when, because it can be swept up by a wind, or it can hit a warmer area of air and continue up for a longer period of time, but it is losing its momentum or its speed. And then we have volume indicators that tell us how volume is changing over time and how many units, say, of Bitcoin are being bought and sold over time. This is useful because when the price changes, the volume gives an indication of how strong the move is. Bullish moves on high volume are likely to be maintained, and those on low volume. Volume is ultimately important because when regardless of what you want to trade, no matter what signals you're getting, what decision you make, volume should confirm what you're going to do. Because if you think an asset is going to go up, but volume is very low or volume's falling, means the rest of the traders don't think so. Then we have volatility indicators. These are measures of rate of price movement regardless of direction. This is generally based on the change in the highest and lowest historical prices. They provide useful information about the range of buying and selling that take place in a given market to help traders determine points where the market may change position. Now, volatility also helps you determine what you should be using for your risk reward ratio. The higher the volatility means the higher the lower risk you should be taking, because and the farther you'd have to set your stop loss from your entry point, because you don't want to get stopped out because the market is bouncing up and down because it's volatile. Volatility indicators tell you how much the price is changing in a given period. Volatility is very important to the market, and without it, there's no way to make money, because that's how we make money in short-term trading on volatility. Because we don't really care that Bitcoin is worth $10,000. We care that Bitcoin is shooting up to 10,005 and then dropping back to 99 because it's volatile and going back up to 10,006. If you're going to buy Bitcoin and put it away in your storage, in your safe deposit box, or in your cold storage wallet, okay, you care that you get at a good price and it's going to go up over time. But when you're trading, you need that volatility, because you want to go into short-term trade. You want to realize that you bought Bitcoin when it fell down to 9,900 because you think it's going to rise back, because the markets are very volatile. So it's most likely going to bounce back up. It may not stay at 10.5, but you want to just get out the second it reaches 10.5. So low volatility indicates small price movements. High volatility indicates big price moves. High volatility also suggests that there are price inefficiencies in the market, and traders spell inefficiency as P-R-O-F-I-T, profit. Then I mentioned before volume indicators. Volume indicators measure the strength of a trend or confirm the trading direction on some sort of averaging or smoothing of the raw volume. So let me give you some tips on using technical indicators. Tip 1, covering more than 5 indicators at any given time is futile. Focus on 2 or 3 indicators and learn their intricacies in and out. Never choose indicators that generate the same signals. Always choose indicators that complement each other. You don't want to choose 3 momentum indicators and ignore a volatility indicator. Confirm your strategy by using an additional indicator or indicators to substantiate a trend suggested by one indicator. And learn what indicators are and why you should choose them. So I'm going to share with you a little short presentation. And it's going to show you something about indicators.
Careful and effective use of technical indicators can improve your odds of finding an investment's best entry and exit points. Technical indicators are calculations based on a trading instrument's past, price, and volume activity. They help technical analysts to predict an investment's future price. Some better-known indicators interpret trend, momentum, volatility, and volume. Multicollinearity is a common problem that occurs when the same indicators are applied to one chart, creating misleading signals. Traders can avoid it by applying different types of indicators to a chart, like a stochastic oscillator to indicate momentum or an average directional index to indicate trend. Each indicator provides a different interpretation. An indicator's variables can be altered to produce different results. For example, a simple moving averages result can change drastically when it's adjusted to account for an additional 20 days or more. Optimizing an indicator is an important part of developing an objective strategy for entering and exiting a market.
So, let me get back to my, there we go. Okay. Now, to find the best technical indicator for your trading approach, test out a bunch of them singularly and then in combination. Regardless of whether you are trading stocks, forex, futures, or cryptocurrency, it is often best to keep it simple when it comes to technical indicators. Okay. Now, if we jump in moving averages, and moving averages is the most simple of technical indicators, I don't use technical indicators. I use support and resistance chart patterns. I do use moving averages, and that's about it. Now, sometimes I do need a little bit of help, and I'm a MACD supporter. I don't use stochastics, I don't use RSI, but people love them. Traders swear by them. You have to find what fits you and then learn to interpret them. And you have to learn the ins and outs. You can't just read a PDF or a book or something that's going to explain it to you and you're going to think you're an expert at it. Okay, because you're going to trade a rule-based strategy, then say, when this happens, do this, and when that happens, do that, when you'll lose your money. You need to learn to read the indicator. Now, you may find you prefer looking at only a pair of indicators to suggest entry points and exit points. At most, use only one from each category of indicators to avoid unnecessary and distracting repetition. Technical indicators are mathematical calculations based on a trading instrument's past and current price and volume. Technical analysts use this information to evaluate historical performance and to predict future prices. Indicators do not specifically provide any buy or sell signals. A trader must interpret the signals to determine trade entry and exit points that confirms his or her own unique trading style. Several different types of indicators exist, including those that interpret trend, momentum, volatility, and volume. Okay. Now, this is a big word, multicollinearity. It's a statistical term that refers to the multiple counting of the same information, and it applies a lot in our industry. Okay. And this is a common problem in technical analysis that occurs when the same type of indicators are applied to one chart. You want to avoid the redundancy. Okay. There are traders that swear by using RSI as stochastics. There's actually now even an indicator called stochastics RSI. Okay. All you're doing is adding and adding the same things together, and you're getting your eye away from price action. Price action is the ultimate thing that makes all the decisions. Remember, these indicators are only your interpreters. They help you hear what the market is saying. But you don't want to be redundant. You don't need 3 indicators telling you the market is overbought. And most of the time, you can figure that out yourself. So the results create redundant signals that can be very misleading. Some traders intentionally apply multiple indicators of the same type in the hopes of finding confirmation for an expected price move. In reality, however, multicollinearity can make other variables appear less important and can make it difficult to accurately evaluate market conditions. Find one you like. Avoid redundancy. To avoid the problems associated with multicollinearity, traders should select indicators that work well with or complement each other without providing redundant results. This can be achieved by applying different types of indicators to a chart. A trader could use one momentum and one trend indicator. For example, a stochastics indicator, which is a momentum indicator, and an ADI or an ADX, which is the average directional index, is a trend indicator. Those combined together can help point out something that's going on with price. Knowing what indicators to use and what is the best combination of technical indicators can dramatically improve your chart reading skill. If you use the wrong technical indicators, this can lead to inaccurate price interpretations and subsequently to bad trading decisions. So remember, we have leading indicators and lagging indicators. Indicators can further be divided into 2 categories based on how they're built. We have oscillators, which I mentioned to you. Oscillators are the most common type of trading technical indicator, are generally bound with between a range. For example, an oscillator may have a low of 0 and a high of 100, where 0 represents oversold conditions and 100 maximum overbought conditions. And then we have non-bound indicators are less common, but these still help form overbought, buy and sell signals as well as show strength and weakness in trends. However, they accomplish this in many other ways using the same set range. Indicators generate buy and sell signals through crossovers and divergence, like MACD. Crossovers are the most popular technique whereby a price moves through a moving average, and when 2 moving averages cross, they give you a buy or sell signal. Okay, let's pop up my chart again. Now, actually, let me get rid of stochastics entirely. Now, MACD, as you see below, has two lines on it. When these lines cross, this is called the MACD line and the trigger line, or the signal line, cross each other, they generate buy and sell signals. Or if you look at the histogram, when it crosses zero, because when the one line equals the other, the crossover would be is at zero. When you subtract one value from the other, it's always going to be zero. So when they cross that zero line and are moving upward, in other words, giving you slightly green, that's generating a buy signal. When they're moving downward and hit zero and then move into the red zone, they're giving you a sell signal. But these aren't sell at this price. If you notice, it doesn't have a price. It's just telling you it's generated a sell signal. It's telling you, hey, open your eyes, look at, there's a possible sell scenario here. Go do your evaluations. Then we have a simple moving average, and we combine that with the second moving average. And we can use two different periods for that. So we take our second moving average, and our first moving average is set at a 9-period moving average. And we can set our second period at, say, at a 20-period moving average. And when we have one cross the other, it can generate buy and sell signals. There's lots of different ways that we can use indicators in our trading, but you have to learn them, because also, if you notice here with MACD and all the indicators, you can customize their settings. So we could decide to use a shorter length period or a faster length period. Okay, we could smooth it over a longer period. Okay. There's all types of scenarios, but it's all based on your strategy and your trading and what you're trading and why you're trading. Like, for instance, if you remember when we looked at stochastics, we had the barrier at 80 and 20. Over 80 going towards 100's overbought, below 30 and going to zero is oversold. We can adjust that to 25, 75, give us less signals, but more reliable signals. Okay, so everything is customizable, and there's all types of gurus out there preaching everything. If you want to do this, do it for yourself. Learn how it is, test it, figure out how it works in your trading. This is what makes you better than everybody else, because anybody can read what a guru says and follow his 5 steps. And all of those guys are the ones losing their shirts. So learn an indicator inside and out, understand it, be the expert on it, and you'll find that it can help you with your trading. Because remember, indicators only indicate. A strategy is a set of objective, absolute rules to define when a trader will act. That's your set of rules. Typically, strategies include both trade filters and triggers, both of which are based on indicators. Trade filters identify the setup conditions. Trade triggers identify each exactly when the particular action should be taken. Guys, I'm going to stop this because I don't think you're hearing it. Let me fix. Give me 1 second. Okay, now I should have it so you can hear it.
indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal into a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. We can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of a trade, and therefore there's an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market is at the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short. We now have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations of the Bollinger Band, and we also have the Super Trend turning back to red Decay to what?
So you can see that indicators only indicate, but by combining them together, we can come up with a strategy. You have to decide how you want to trade and what fits your style and your personality. Like I said, I use very little indicators. Other people rely heavily on indicators. It's really up to you. But in order to learn them and master them, you have to learn their personalities, learn how to customize them, learn how to put them together, and make sure that you're not using duplicate indicators. So thank you very much for joining us today. Thank you for supporting Legacy FX, and we'll talk to you again real soon. Remember, click the download button and download those 2 guides because you can't get them except during the live class. And have a great trading day. Bye now.